Hello and welcome to the monthly Market Insights with 𝗺𝗏 𝗙𝗏 Associates. In the US markets, escalating tensions in Eastern Europe upended markets in February, sending stocks lower for the month. The Dow Jones Industrial Average dropped 3.53%, while the S&P 500 index fell 3.14%, and the Nasdaq lost 3.43%. The buildup of Russian troops on the Ukrainian border dominated the market last month, even before it culminated in a late February invasion. Volatile stock prices turned lower as hopes for a diplomatic solution faded over the course of the month. The S&P 500 index fell into correction territory on the eve of the invasion. As investors woke up to learn that the invasion was underway, stocks suffered steep declines in early trading on February 24th. However, they soon staged an extraordinary rally that saw the S&P 500 end the day 1.5% higher after being down more than 2.6%. The Nasdaq closed 3.3% higher after dropping nearly 3.5% during the day. That momentum continued into the following day, but then faltered on the final trading day of a difficult month for investors. Now, prior to the geopolitical tensions, investors had been focused on market fundamentals like economic data and corporate earnings. Continued positive corporate earnings surprises buoyed investors, outweighing hot inflation numbers. With the Omicron variant waning, investors were looking forward to an economic recovery in 2022, but the economic impact of the invasion may dampen that forecast. Those events have also placed the Fed in a more difficult position. It's looking to lower inflation this year, but must balance a potential slowdown in economic growth due to geopolitical events. Except for energy, all industry sectors closed the month with losses, including communication services, consumer discretionary, consumer staples, financials, healthcare, industrials, materials, real estate, technology, and utilities. The Federal Open Market Committee, FOMC, is meeting on March 15th and 16th. The Fed is expected to announce the first of several federal fund rates hikes in 2022 and provide greater clarity on its monetary tightening plans. While the market consensus is that the Fed will hike interest rates by 0.25%, the Russian invasion of Ukraine has added a layer of uncertainty. Raphael Bostic, president of the Federal Reserve Bank of Atlanta, commented in a late January interview that the Fed has not ruled out a 50 basis point hike. In the past, markets have reacted to FOMC meeting updates and the follow-up remarks made by Fed Chair Jerome Powell at post-meeting press conferences. March may be no different. Overseas, markets reacted to the event in Eastern Europe, as the MSCI EAFE index slipped 2.01% in February. Major European markets were mostly lower. Germany dropped 6.53%, Italy fell 5.21%, and France lost 4.86%. The UK was flat at a negative 0.08 as it loosened its COVID-related restrictions. Stocks in the Pacific Rim markets were mixed, with Australia gaining 1.11% on higher commodity prices. China's Hang Seng Index lost 4.58%, while Japan's Nikkei slipped 1.76%. In regards to economic indicators, the second update on fourth quarter GDP was revised higher from 6.9% to 7.0%. Regarding employment, the economy added 467,000 jobs in January, exceeding expectations. The participation rate rose as the unemployment rate ticked up to 4.0%, which was due to more workers entering the labor market. Wages climbed 0.7% last month, bringing year-over-year wage increases to 5.7%. In retail sales, they rebounded in January, rising a better-than-expected 3.8%. The increase was led by strong gains in furniture and home furnishing sales and in motor vehicle and vehicle parts sales. Industrial output surged 1.4%, which was nearly triple the consensus expectation. Capacity utilization increased 1%, reaching its highest level since March 2019. Housing starts slipped 4.1% in January due to freezing temperatures across the nation. Existing home sales surged 6.7% as the supply of homes dropped 16.5% from a year earlier. New home sales slipped 4.5% from December and 19.3% from January 2021. Inflation rose to a 40-year high, with January prices climbing 0.6% and year-over-year costs increasing 7.5%. Core inflation, excluding food and energy, grew 6% from January of 2021. And orders for long-lasting goods rose 1.6%, which is double the consensus estimate. For the Feds, in minutes from the Federal Open Market Committee, the FOMC two-day meeting ending January 26, the Fed reaffirmed its plans to raise interest rates and shrink the Fed's balance sheet. Some officials expressed concern about financial stability and the stubbornness of inflation. Some participants reported that their business contacts remained concerned about persistently high inflation and that they were adjusting their business practices to cope with higher input costs, for instance, by raising output prices or utilizing contracts that were contingent on their costs, according to the minutes. Participants generally expected inflation to moderate over the course of the year as supply and demand imbalances ease and monetary policy accommodation is removed. And that's all for this month's Monthly Market Insights from March 2022. If you have any questions, give us a call at 1-800-467-8152 or give us an email at info@ronaldgielock.com.